Good afternoon. Welcome to the weekly livestock market update. I'm Brownfield anchor reporter Megan Grebner. With us, as always, to talk all things livestock markets is University of Missouri Scott Brown. Good afternoon, Scott.
Good afternoon, Megan.
There's plenty for us to get into this week. We're going to talk a little bit about slaughter, a little bit about consumer sentiment. But before we get into all of those things, let's recap what happened this week in the markets.
If we start with the cattle side of the equation this week, cash cattle were down about $2 this week. Those feeder cattle markets, it was a tough week for them. They were anywhere from steady to $6 lower this week. The February live cattle futures contract closed down $1.85, and the March feeder cattle futures contract closed down $1.50. If you look at the corn side here, March corn futures were up almost 35 cents this week. So a lot of strength in the feed cost side of the equation. Choice box beef prices were $4.25 higher this week. On the hog side, cash barrel and gut prices were nearly $1 higher this week, while the February lean hog futures contract closed down 80 cents. On the pork side, the pork cutout value gained $2 on what was some pretty good strength in terms of ham prices.
Scott, how much are we watching? And we'll get into this a little bit later too, but that jump up in corn prices specifically as it looks like there's some pressure on the cattle side of things.
Yeah, so it's certainly something that we haven't had to talk about much until here in the last really 45 to 60 days. USDA certainly tightened up the corn S&U in particular that makes us more of a concern. And I guess right now, we're really looking for what happens in terms of both plantings here in the United States as well as what we get harvested in South America as really probably the next big market movers potentially. And we have decent crops in Brazil, which there's been some concern of dry weather, or we plant a lot of acres here in the United States to corn. Perhaps we start to moderate some of this run up in prices we've seen of late. But if not, and we get strong export demand, we still could face higher feed costs going forward.
Slaughter is something that we've been touching on every week lately. And we talk on the hog side of things that it's at 2.7 million head that we want to see. And we did not hit that this week. Let's talk a little bit about what happened this week as we look at those slaughter runs.
Yeah, if we start on the cattle side, so USDA is saying this week a cattle run of 651,000 head. That's up nearly 3% from where we were a year ago and basically unchanged from a week earlier. To me, we're actually starting to get ourselves maybe a little more current on the cattle side of the equation, which is all good news. On the hog side, a run of 2.654 million head, according to USDA for this week. That is down nearly 200,000 head from where we were a week ago, but it's almost 6% higher than where we were a year ago at this time. So although you and I have talked a lot about 2.7, perhaps as we get a little further down the road here, we don't need to make quite that big a run in terms of hog numbers, but we're still going to need to make some pretty good runs here for a while.
Do we worry about knowing that we're having these large slaughter runs and we're obviously still trying to move through, at least in some parts of the country, the backups in the production system, but the amount of pork then that's coming online and where it needs to go and how demand for that product comes into play?
So certainly, to me, more of an issue than maybe where we're at on the cattle side of the equation in terms of, yeah, we need strong demand because we're going to probably push a lot of supplies at the market when you think about the pork side. A little less of that issue going on cattle. So maybe we'll get the strong demand, which in fact we have been getting. This is not really a new song that we're singing on the hog side. We've been growing pork production pretty rapidly now for a few years. Demand's been able to really offset in some part due to China. And so, but if that were to change, these kinds of runs might create some lower pork and eventually hog prices if we don't have that strong demand.
Retail prices are showing some demand strength for 2020.
Yeah, so we got from USDA this week annual averages for 2020. So we'll spend a little bit of time here. The choice beef retail price came in at $6.54 for 2020. That's a little more than 8% higher than it was in 2019, and just remind us of what a roller coaster 2020 was. May beef retail prices were 23% above year ago levels, while we go out of 2020 with December 2020 only up 3.3%. On the pork side, pork retail prices $4.03 for an annual average in 2020. That's 4.8% above year ago levels. A little less of that big peak, so in June we got 425 prices that were 8.3% higher. As we look here at December, we've actually seen an increase in pork retail prices, 8.1% above year ago levels. So a little different story in terms of beef and pork. If we just look at some of those COVID effects, maybe a little bit further, boneless pork chops were 11% higher than they were in 2019, while bacon was 0.5% lower. So a little different story in terms of some of those products, depending on whether it was strong grocery store demand or weak HRI trade.
I think it really goes to show kind of how uh, our demand or our consumption changed significantly over the course of 2020 as COVID uh, got worse and peaked and did its thing this last year.
For sure, nothing like shutting off for a period of time that whole food service side of the equation to make things like bacon lose a lot of value, and then just to see them roar back as we get further in the year. I mean, all of that is what an amazing time we've been through. I hope we don't repeat it here in 2021.
And we just continue to skyrocket and see demand and everybody back out and able to enjoy restaurants and travel and all of those things that make our economy boom again.
I look forward to the day you and I can have that conversation.
Yes. Speaking of COVID related impacts, consumer sentiment, as we look at that number from January, definitely impacted by the spikes in cases and what's been going on with COVID.
That's right. So we have January preliminary consumer sentiment information out for us. We did fall in January 1.9% relative to where we were in December. Again, not surprising given some of the increase in COVID cases that we've been talking about. That current economic conditions portion of the index fell 2.6% month over month, really led us lower. And again, as those COVID cases have been increasing, I think that's really been a little problematic in terms of overall consumer sentiment.
As we wrap up the big reports of the week, supply and demand, probably the biggest report, and I would say definitely packed a little bit of a punch this month.
Yeah, for sure. So I'll start by the positive side of it. So higher prices. All right. So when I say higher prices, I'm going to talk about higher cattle, higher hogs, higher chicken, higher turkey. So USDA did in fact increase their estimate for livestock prices for 2021 in this January report. That's the good news of higher prices. And in fact, to me, spells a little bit of maybe more positive demand in USDA's outlook for 2021. However, feed costs continue to be ratcheted up by USDA as well. This month, their 20/21 corn price up 20 cents, while they raised soy meal price over that same period by $20 a ton. Just to put that in perspective, if that soy meal price of now what's a $390 a ton is what ultimately happens, that's almost $100 a ton higher than where we were a year ago, and 75 cents or so on corn prices as well. Those are feed costs levels we haven't seen really since 2013, 2014, Megan.
I think the other part of that conversation is, I mean, we talk risk management on both sides of it, managing risk with feed costs, your input costs as well. But I want to talk about how does this set up for 2021 and profitability in terms of profitability when we look at these feed costs on the rise, but we're also looking at some drought pressure and some concerns about dryness in the West, and how does that all figure in together?
I wish I had a good answer for the risk that's laying out there. We certainly know that it's gone up. USDA is now saying a corn ending stock number of about 1.5 billion bushels. We haven't, and soybeans less than 200 million bushels. We haven't been at those level of stocks in quite a while. So markets react quickly to either positive trade news or negative supply news. I think we're gonna have that unfold here in 2021. I say that and I go, I think when you look at what's going to happen come summer of 2021, do we end up in a situation where we start talking about dry weather? And if we do, perhaps we're going to talk about feed costs that shoot up more quickly because we don't have the same stock holding that we would have had just a few years ago. So we're going to have to be more careful about that price risk management. I will say for me, the problem is where we sit now. I'm a little careful about what to say because we've already seen a pretty substantial run up in prices. And now it comes down to what South American crops look like, as well as then what we plant here in the US come spring. So we want to be careful, but at the same time, there's still a potentially upside pressure on these prices.
Do you feel like we need, as producers, livestock producers specifically, as you and I talked today, need to be very cognizant and in looking at their bottom line cost of production and being able to look at that big picture? And I think about this in terms of the fact that while farm incomes were up in 2020, how much of that is contributed to ad hoc payments, and how do we figure that in as we look ahead to this coming year?
Yeah. So for sure, you look back at 2020 and it would have been a much different year in general had it not been for government outlays that we have. We're kind of sitting here in 2021 where we think we get kind of beyond the worst of COVID as we get in the second half of 2021. None of us know for certain how that plays out, but if it doesn't, all of a sudden you talk about what are lower livestock prices but higher feed costs. We could certainly find ourselves in a very crunch situation. And I like to keep reminding us, so risk management, why do we do it? We don't do it to hit home runs. We do it to reduce volatility. And sometimes that's a tough pill to take, but it's part of what makes us in a viable situation longer term. And I think that's where thinking about how to do risk management in 2021 is going to become much more important than we've seen for a while. Just as we might talk about trying to lock in feed costs, we get a really positive demand boost on the livestock side of the equation that drives cattle and or hog prices higher. We may want to take advantage of that. Doesn't say those prices can't go higher, but if we have some type of profitable return, maybe we want to cash in and let somebody else carry some of that risk for a while.
Scott, I think that'll do it for us this week as we look ahead to next week. A pretty big week for us there.
That's right. We get livestock slaughter out next Thursday, and we finish next week with a cattle on feed report.
The first one of 2021.
Will be interesting to see what placements look like here in this January report.
Scott, great to see you. We will see you again next Friday.
Very good, Megan.
To have our weekly livestock market update delivered to your email box every Saturday morning, visit our website, brownfieldagnews.com. You can click subscribe. You can also submit questions and comments there as well. And you should check out all of the really great Brownfield podcasts, which you can find at brownfieldagnews.com/podcast. Have a great weekend. I'm Megan Grebner for Brownfield.